If I just invest in an ETF savings plan for 15 years, nothing can really go wrong. Have you ever heard that? It sounds so solid, almost like a guarantee. But unfortunately, it's not that simple. In this video, we're going to dive deep into how safe an ETF savings plan really is, what that famous 15-year rule actually means, and why you should never blindly trust average returns. We'll compare savings plans with lump sum investments, look at real historical data, and even debunk a common myth about the cost-average effect. Stick around, because what you learn today could completely change how you approach your long-term investments. So, where does this 15-year rule even come from? It's a well-known idea in the world of finance that says if you invest in a globally diversified stock portfolio for 15 years, you've historically never lost money. This is mostly based on data from the MSCI World Index, which has been tracking over 1,400 companies from developed countries since the 1970s. And it's true. On average, over all possible 15-year periods, the return was around 7 to 8% per year. But here's the key word: average. That doesn't mean every single investor got that return. Your personal result can be wildly different depending on when you start and when you sell. For instance, if you had invested a lump sum in the year 2000, right before the dot-com bubble burst, you would have had to wait until 2013 just to get your money back. On the flip side, someone who invested right after the 2008 financial crisis probably saw double-digit annual returns for years. So, that 15-year rule isn't a magic shield. It's just a statistical observation from the past. To really understand this, we need to look at something called rolling returns. Imagine we calculate the return for every possible 15-year period since 1970. So, we look at 1970 to 1985, then 1971 to 1986, 1972 to 1987, and so on. This gives us a much clearer picture of how much returns can vary. For the MSCI World, the average 15-year rolling return for a lump sum investment was about 8% per year. But the range was huge. The best period delivered an incredible 14.6% per year. The worst, it was just 1.3% per year. So, while you didn't lose money, you barely beat inflation. This shows that even over a decade and a half, there's still risk. Especially if your starting point is right before a major market crash. This brings us to a classic debate: lump sum versus an ETF savings plan. Should you invest $10,000 all at once, or put in $200 every month? Both strategies have their merits, but they lead to very different outcomes. With a lump sum, all your money is in the market from day one, working for you and benefiting from the power of compounding. The downside is the timing risk. If you invest right before a crash, it hurts. With a savings plan, you invest gradually. This reduces the stress of trying to pick the perfect moment to invest. Most people think this makes savings plans safer, but that's not the full story. They are psychologically more comfortable, for sure, because you're not putting all your eggs in one basket on a single day. But are they mathematically safer? Let's look at the numbers. Let's imagine you started an ETF savings plan on the MSCI World back in 1970, investing $200 every month. If we look at a 5-year period, the results are all over the place. The worst 5 years, from 1970 to 1975, would have turned your $12,000 invested into just $7,600. That's a loss of 18% per year. But the best 5 years, from 1995 to 2000, would have turned your investment into almost $25,000. Conclusion: a 5-year horizon is pure gambling. Okay, let's extend it to 10 years. Still very volatile. The worst decade, from 1999 to 2009, still lost you 9% per year. The best decade, however, gave you a massive 21% annual return. Now for the famous 15-year mark. If you invested $200 monthly for 15 years, that's a total of $36,000 invested. The average return was a solid 8% per year. The best period, from 1974 to 1989, would have turned your $36,000 into an amazing $75,000. But what about the worst case? The worst 15-year period for a savings plan, from 1994 to 2009, actually resulted in a loss. Why can a savings plan sometimes be riskier? It sounds completely counterintuitive, right? It all comes down to how much time your money spends in the market. In a savings plan, your money is, on average, invested for a much shorter time. If you invest $36,000 over 15 years, the first payment is invested for the full 15 years, but the last one is only in the market for a month. A large portion of your capital is added toward the end of the period. If a market crash happens near the end of your 15-year timeline, it hits the largest amount of your accumulated capital, and there's very little time to recover. With a lump sum, all your money is in from the start, so it has more time to ride out the downturns and recover. This doesn't mean savings plans are bad. Not at all. It just means they aren't automatically safer. So what happens if we look even further into the future? The longer you invest, the more stable the returns become. For a savings plan, the worst 20-year period gives you a small positive return of 0.3% per year. Over 25 years, the worst case improves to 2% per year. And over 30 years, the worst case return jumps to 5% per year, while the best is 13%. You see the pattern. The gap between the best and worst outcomes shrinks dramatically over time. This is a classic financial principle called regression to the mean. Long-term investing is the ultimate risk smoother. Let's quickly touch on the cost average effect. This is the big selling point for many savings plans. The idea is that by investing a fixed amount regularly, you automatically buy more shares when prices are low and fewer when they're high. This gives you a better average purchase price. It sounds great, but there's a catch. This effect is most powerful when the market is moving sideways or down. But historically, markets tend to trend upward over the long run. This means that most of the time, investing your money earlier is better than spreading it out. The cost average effect is more of a psychological comfort that helps you stay disciplined rather than a magical formula for higher returns. So, how do you apply all of this in practice? First, if you're investing regularly through a savings plan, you need to think truly long-term, not just 15 years, but ideally 20, 25, or even 30 years. Remember that each monthly contribution starts its own investment journey. Your first payment might be invested for 30 years, but your last payment might only be in the market for a few months. That's why having a long-term mindset is so crucial to actually achieve those attractive average returns we always hear about. And there are two more things we can't forget: inflation and taxes. The historical returns we've been talking about are nominal. They don't account for the fact that money loses value over time due to inflation. If you get an 8% return but inflation is 3%, your real return is only 5%. Still good, but it's important to remember that long-term investing is also about preserving your purchasing power, not just growing the number in your account. As for taxes, you will have to pay capital gains tax when you eventually sell. However, the exact amount depends on your personal situation, and you can often use annual tax allowances to minimize the hit, especially in retirement. But let's be realistic. Very few of us have a large lump sum of money just sitting around waiting to be invested. An ETF savings plan is a fantastic tool because it fits into our everyday lives. We invest a portion of our income month after month. The most important thing is managing your expectations. Don't fall for the myth that 15 years equals guaranteed safety. If you're getting close to retirement, you need to be especially careful. Your most recent contributions have been invested for the shortest time and are therefore the most vulnerable to a market downturn. It might be wise to start reducing your savings plan about 5 years before you plan to retire to lock in some gains. At the same time, you probably won't withdraw all your money at once. You'll likely take it out gradually over many years, which extends your investment horizon and naturally reduces risk. So, what's the key takeaway from all of this? It's simple. Time in the market beats timing the market. Historically, investors who have stayed invested for 20 or 30 years have always seen positive returns. Yes, there will be scary downturns, but over a long enough timeline, they just become blips on the chart. An ETF savings plan isn't a magic trick to eliminate risk. It's a disciplined and accessible way to participate in the long-term growth of the global economy. Whether you're investing a lump sum or $200 a month, consistency and patience are your greatest allies. If you found this video helpful and it gave you a new perspective on your investment strategy, please give it a thumbs up and subscribe to the channel for more practical insights on finance and ETF. Thanks for watching, and remember, patience is the most valuable currency you have.